What if your financial advisor has a secret? Not a shady one necessarily, but one that could be costing you thousands in potential gains. Think about your portfolio. Does it look a little vanilla? Maybe a handful of large company stock funds, a bond ETF, and that's about it. It's the standard, sensible shoes portfolio. It's safe, it's simple, and it's what everyone else seems to have. But here's a thought. Are you paying advisor fees for the same portfolio you could build yourself in a weekend? The truth is, there's a whole universe of investments that some advisors may never bring up. And it's not always because these investments are bad. In some cases, it might be because they're too good, or more likely, too complex for the standard cookie-cutter model many firms rely on. In this video, we're pulling back the curtain. We're going to explore the real reasons certain investments, like private funds and different types of annuities, might not be on your advisor's go-to list, and more importantly, what you can do about it. This isn't about firing your advisor. It's about making you the smartest person in the room when it comes to your own money. Section 1. The Great Wall of Normal Investments. First, let's break down why your portfolio probably looks the way it does. Most financial advisors use a standard set of building blocks: publicly traded stocks, bonds, and a mix of mutual funds and ETFs that track the market. And let's be clear, there's nothing inherently wrong with this approach. It's diversified, it's liquid, and it's easy to grasp. For an advisor managing hundreds of clients, this model is efficient. They can create a few model portfolios, conservative, moderate, aggressive, and slot clients in based on a simple questionnaire. It's the assembly line of financial planning. The problem isn't that this is a bad strategy, it's that it can be basic. You might be paying for a custom-tailored suit, but getting something off the rack. This model can sometimes overlook powerful tools that could enhance your returns, lower your taxes, or provide income streams that basic stocks and bonds simply can't. So why might they not show you these other options? It can boil down to a few things: complexity, the way they're paid, and potential conflicts of interest. And that brings us to the investments they might be keeping under wraps. The forbidden funds, what they may not be showing you. Let's get into the specifics. Here are a few types of investments and strategies that might not be on your advisor's radar, and the real reasons why. The high commission annuity. You've probably heard of annuities, usually for retirement income. An annuity is a contract with an insurance company. You pay them, and they promise you income in the future. They can be a great way to create a personal pension. So why would this be hidden? Well, it's a tale of two extremes. Some advisors might push certain types of annuities aggressively. Others avoid them entirely. The trouble often lies with the complex high-commission versions. Here's the potential issue. Some indexed or variable annuities can be loaded with huge surrender charges and hidden fees. But the real kicker can be the commission. An advisor might earn a 5%, 7%, or even higher commission on the entire amount you invest. On a $500,000 investment, that could be a $25,000 payday for them up front. This creates a potential conflict of interest. Is the advisor recommending it because it's the best product for you, or because it comes with a big commission? While many modern annuities are simpler, with lower fees or no commission at all, some of the most complex products are still out there. A fee-only fiduciary advisor will typically avoid commission-based products altogether because their professional standard prohibits it, not just because it's a headache. The private market playground. When you think investing, you probably picture the stock market. But what about investing in companies before they go public? That's private equity. Or lending money directly to businesses for a high-yield return. That's private credit. Welcome to the private markets. This used to be the exclusive playground of institutions and the ultra-wealthy. But today, access is widening, and there are funds that allow accredited investors, that's someone with a certain income or net worth, to get a slice of the pie. So why might your advisor not bring it up? First, complexity. These aren't like buying a stock on your phone. They involve complex legal documents and long lockup periods where your money is illiquid. Many advisors may not be experts in this area. Second, access. The advisor's firm might not have relationships with these private funds. It's much easier to stick to the pre-approved list of public funds, and that access is still often limited to those who meet specific income and net worth requirements. Finally, it messes with the simple portfolio model. and a liquid long-term investment doesn't fit neatly into a standard 60-40 portfolio that's rebalanced quarterly. It requires more work and specialized knowledge, so for some, it's easier to stick to what they know. The sneaky mutual fund share classes. This one can be incredibly subtle. You might own a popular mutual fund, but did you know there can be different share classes of the exact same fund? Class A, Class C, and so on? They hold the same stocks, but have wildly different fee structures. Here's how it can work. A shares might have a front-end load, a commission you pay upfront that can go to the advisor. C shares might have no upfront fee but a high annual 12b1 fee, an ongoing commission paid to your advisor every single year. These fees come directly out of your returns. The issue is that there is often a cheaper share class available, like an institutional or no-load version with lower fees. However, an advisor might be incentivized to sell you the more expensive share class because it's how they get paid. They might show you the fund, but not mention the cheaper version of the exact same investment. The SEC has run initiatives cracking down on advisors who select higher-cost share classes that pay them fees when a cheaper option is available for the client. The overlooked tax-saving strategies. This last one isn't a fund, but a strategy so powerful it can act like one. Advanced tax management. I'm talking about things like tax loss harvesting and asset location. Asset location is about strategically placing investments in the right accounts. For example, you put tax-inefficient investments, like corporate bonds, in tax-sheltered accounts like your IRA, and more tax-efficient ones, like growth stocks, in your regular brokerage account. This can significantly boost your after-tax returns without changing your investments at all. Tax loss harvesting is where you sell a losing investment to realize a loss, which can then offset gains and lower your tax bill. You then buy a similar, but not identical investment to stay in the market. So why might an advisor skip these? Often it comes down to their service model. Implementing these strategies requires active monitoring and a good handle on the tax code. It's more work than hitting a rebalance button once a year. Some advisors offer a set-it-and-forget-it portfolio, but you're still paying them a fee year after year. For that fee, you should know if more active tax management is on the table. Okay, so it can feel like the system has pitfalls, but it's not hopeless. Knowledge is power, and now you have the knowledge to change the conversation. It's time to move from being a passive client to an active partner. Here's your action plan. Schedule a meeting with your advisor and be ready to ask 5 critical questions. Their answers will tell you everything. First, how are you compensated on this specific investment? Don't ask about their fee in general. Ask about a specific fund. Is it a commission, an ongoing 12b1 fee, part of a wrap fee? Make them spell it out. Second, are you required to act as a fiduciary for all of my accounts, and can I get that in writing? A fiduciary is legally obligated to act in your best interest. A broker just has to recommend something suitable. The difference is huge. The regulatory landscape around this has been in flux for years, so getting a direct, written answer is crucial. Third, what are all the fees associated with this investment, including its internal expense ratio? They might tell you their advisory fee, but you need the all-in cost. This includes the fund's own expenses, trading costs, and any other layers. Fourth, can you show me some lower-cost or more tax-efficient alternatives to what you're proposing? This question puts the ball in their court. It shows you no alternatives exist and forces them to justify their recommendation against other options. Fifth, could my portfolio benefit from strategies like asset location or tax loss harvesting? This shows you're thinking about not just returns, but after-tax returns. It's a great way to test their expertise beyond just picking funds. Your experience can help someone else. If you've ever discovered you were in a high-fee fund or had an advisor who went the extra mile for you, share that story in the comments below. Let's build a community of informed investors. And if you found this breakdown valuable and want to learn more about how to build a portfolio that truly works for you, make sure you subscribe and hit that notification bell. The goal here isn't to make you distrust financial advisors, ethical advisors out there who are true fiduciaries. But it's also true that the industry has conflicts of interest that aren't always obvious. You are the CEO of your financial life. Your advisor is a key hire to help you execute your vision. By asking the right questions and understanding the system, you can transform that relationship from one of passive trust to one of active partnership. Don't settle for a vanilla portfolio if you suspect it's not getting you closer to your goals. It's your money. It's time to make sure it's working for you, not just for your advisor.